Yes. So the rule of 40. Um, I learned about the rule of 40 not too long ago. It was probably about 2 years ago. Yeah, it was Ryan, taught me it. And I thought that it would be good to kind of teach people what it is because I had no idea what it was at the time. So let's go back to school. So the rule of 40 is a commonly used metric when comparing SaaS companies or software as a service companies and is a simple framework that balances revenue growth versus profit margins. And essentially, it's a rule of thumb to quickly determine the health or attractiveness of a SaaS company. So, for a quick general example, if a theoretical company has 20% revenue growth and profit margins of 20%, we would add those two figures together and the company would have a rule of 40 score of 40%, meeting the threshold of the rule of 40. Now, essentially, all we're doing here is just taking the revenue growth and the profit margin and getting our score. So if a score is above 40, it is considered a passing grade, while a score below 40 means that the company fails the rule of 40 test. But let's go a little bit deeper here. So for the revenue growth, you can either use recurring revenue growth or total revenue growth. If subscription revenue comprises most of the business's total revenue, we can generally just go ahead and utilize total revenue. And then for profit margin, it is common practice to use Ebitda margins or earnings before interest, tax, depreciation, and amortization. And the reason being is because Ebitda tries to place companies on a common playing field by stripping out interest from debt, differences in taxation, and accounting policies to approximate its operating cash flow. Now, generally speaking, there is a trade-off between revenue growth and high margins. For example, if a company has high revenue growth and low margins, it is likely because the business is investing heavily into sales and marketing, thus reducing margins. But of course, this is not always the case. But you can see there's a little bit of a balancing act that goes on between the two. So now that we know how it is, or what it is, and essentially how to calculate it, let's look at a real life example from a couple of companies rated as Monitor in our recent US SaaS software technology report, which was released to clients. So the two companies that I'm going to look at here is DigitalOcean Inc., DOCN, on the New York Stock Exchange. Essentially, this company operates a cloud computing platform that provides on-demand infrastructure and platform tools. Its solutions include website hosting, web and mobile apps, video streaming hosting, gaming development, and more. And I'm going to compare it with Palantir Technologies, PLTR, on the NASDAQ. Aaron's talked about this company a bit before, and it is a SaaS company that revolves around data collection and analysis. So I'm just going to quickly go over DigitalOcean and then Palantir. So this is all for the fiscal quarter Q2 of 2022. Technically, if we wanted to look at the year results or the 12 trailing month results, that would work perfectly and it would actually smooth out any quarterly variations. But just for this, taking you guys back to school, I'm just going to look at the Q2 2022 results. So for DigitalOcean, revenue growth was 29%, and they have an EBITDA margin of 34% in the last quarter. So you just add those together and we get a rule of 40 score of 63 or 63%. Palantir, on the other hand, has revenue growth of 26% and an EBITDA margin of 24%. Adding those two together, we get a rule of 40 score of 50 or 50%. So as we can see, both companies surpassed the threshold of the rule of 40 with DigitalOcean's score of 63, while Palantir's score is 50. And based just off this one metric, DigitalOcean appears to be the more superior business. But of course, this is just one financial metric. We would look at much more than this to determine if a business is investable or not. But essentially, that is what the rule of 40 is for SaaS companies. And now you can consider yourself schooled.